Once again, ladies and gentlemen, boys and girls, and children of all ages, you are now tuned into the Investor Show with your host, the Prince of Investing, Prince Dykes, coming all the way live from the beautiful state of Denver, Colorado. Don't forget to hit that like, subscribe, comment, and share button, and hit the bell icon to get notifications. But as always, I don't have a lot of time, and I definitely know you guys and girls don't have a lot of time, so we're going to jump straight into it. So as you can see in the description, this video is going to be about the Lyft IPO, down about 18% since its IPO. Now, the IPO is the initial public offering. That is the day that it initially comes offered to the public. It came in about $85, as you can see here. You always see these huge one-day jump all the way up at $85.38. And as we can see today, as of April 2nd, the market hasn't opened yet. It's down to $69, from $85 to $69. Now, okay, Prince, why are you bringing this up? Because as y'all know, this past weekend I did a live on why I don't purchase IPOs. This is a prime example why I don't purchase IPOs, because it's a bunch of gas. It's a bunch of rally and woo 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 woo. This is going to be the great big thing or whatnot. It has no financial backing, which means that you don't see any of the numbers. You have no 10Qs. You don't have any quarterly reports to go off of, any financial reports to base this off of. It's really just all hype. I'm not saying it's not a great company. It may go off to do great things in the future. But when something new comes to the market, now it has to meet Wall Street expectations. Now it has all these, it's being so scrutinized every single day, every single minute of the day. The stock is being evaluated. So, I mean, the CEO can get on the phone and say the wrong thing and the stock can start crashing. So this is why you have to be very, 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 very careful with IPOs. It's just not even worth it. Now, like, you got to look at a company like Facebook. When it came out, it did its initial public offering. Yes, it goes through the ringer, but over time, it may it may turn to a good stock. But it's not worth it jumping into a company that you have no finances on or no acknowledgement. The people who really the people who are really banking on these situations are the people who got in when it was a privately traded company. You know, the people that are ringing the bell on Wall Street, New York Stock Exchange, and they're clapping because the company went public. Those are the ones who made out like a fat rat. Those are the ones who probably got the stock for about $20 or $10 or something like that, and they made an 800% return on the day that the bell opened. But for the everyday person that just goes in and just waits and buys a stock the day it goes public, 90% of the time, in a short term, you're going to lose, and it's very risky. It's too risky. Now, over the long term, 5 years from now, this stock could be the next Amazon, who knows? But as of right now, I cannot make that judgment on initial public offering. When that 10Q comes out, when the quarterly reports come out, then I can make a better assessment. When the annual report come out, then I can make a better assessment. But as of now, just because it's a hot company, Uber is going to be next, Airbnb is going to be next, and there's going to be plenty of public offerings. But this kind of reiterates what I spoke about over this weekend, why I don't touch IPOs. And here's a prime example. If I would have jumped in and got this thing at $85, now you're down almost 20%, hoping that it rallies or whatever the case may be. So anyway, don't forget to hit that like, subscribe, comment, and share button. Check out the description box to support us. Until the next video, podcast, cartoon, or whatever else you see me do crazy around the globe. Peace, be safe, I'm out, and thank you.